Hello, welcome to FIN301, Module 3, session-long project number 3, Risk, Return, and Stock Valuation. Module 3 SLP requires you to make 3 stock purchases, provide information about the purchases, and calculate and interpret the standard deviation. So they want you to buy stock in 2 companies that have returns that are inversely related. In other words, you might choose to buy stock in a company that does well when oil prices rise and one that does poorly when oil prices rise. You might explain this in the spreadsheet in the field reason for buying. So buy a stock that has a counter-cyclical returns. That's the other part of this. In other words, its returns are inversely related to the business cycle. So in terms of calculating the standard deviation, you can use the SDEV calculation, SDEV, in Excel, that function in Excel, and there's instructions for that in the Excel template. Reach out to your instructor if you have questions on that. Regarding inversely correlated returns, inverse correlations between X and Y mean that when X goes up in price, Y goes down, and when Y goes down, X goes up. A direct correlation is the opposite. If there's a direct correlation, it means X goes up and Y goes up. So the S&P and the Dow are both stock indexes. They both invest in baskets of stocks. They invest in different stocks, but they're basically highly correlated. So when the S&P goes up a point, the Dow usually goes up a point too, or somewhere close to that. So there's a very high correlation. Even the S&P and the NASDAQ, which is general market and versus tech stocks, have a fairly high correlation over time. So how do we find an inverse correlation? It's not easy. It's not easy to find inverse correlations because they change over time. So in the past, airline stocks went down when oil prices went up. That was when we had peak oil back in 2009, 2008, during the second Gulf War. When oil prices got really high, and then after that, in the years following that, we had very high oil prices, and that cut into the profit margins of airlines. So when oil prices went up, Exxon stock would go up, and then Delta Airlines stock would go down because their input costs were higher, their fuel costs were higher. Same went for FedEx and other shippers, other freight transportation companies. In fact, I think Yellow Freight almost went bankrupt when oil got so high. Now we've had an implosion of oil prices, right? Oil prices have gotten cheaper and cheaper and cheaper. And in 2015, oil got really cheap, 2015, 16, 17. And sometimes oil during those years would go down, and people also flew less because there was a recession. So both Exxon and Delta went down in price during that time. They went down at the same time. They were directly and not inversely correlated. Now, during COVID, Amazon and Walmart are inversely correlated. And Fastly Inc., which is like I think they're a cloud software services provider, something like that. I'm not exactly sure what they do, but they're a tech company. Because they're virtual and they support working from home and all that stuff, they did very well during COVID. And Exxon did very poorly during COVID because oil prices went negative. So Fastly Inc. and Exxon have an inverse correlation during COVID. So when COVID's over, that might all change. But for now, Amazon goes up and a lot of value stocks go down because a lot of value stocks are pegged to COVID reopening. A lot of retailers like Urban Outfitters and Walmart and that kind of thing, they're pegged to COVID reopening, and Amazon is going to do well either way. But they're going to grab more market share as long as these stores are shut down due to COVID, or they're experiencing less traffic due to COVID risk. So, so where does that leave us with oil? Well, right now, oil and airlines are both still correlated positively because if COVID ends, if we get past all the variants and everything and the vaccines work, then we're going to have a situation where the economy is going to reopen. People are going to use more and more fuel. They're going to use more and more gasoline. They're also going to fly more. So airline stocks will do better once the COVID risk is gone, and so will oil stocks. So they're directly correlated. But once oil gets to $150 a barrel or $200 a barrel at some point, if it does get up there, and the airlines are already priced to perfection because people are flying as more than ever, they couldn't take a vacation for 2 or 3 years, so now they're, or they chose not to, so now they're getting out there, they're taking their vacations, and they're spending more money than ever. If oil gets up to 200 a barrel or 150 a barrel, that will start to create an inverse correlation, and airline stocks will go down if oil gets too expensive. So, we're in the sweet spot right now where oil can go up and airlines will go up too, because they both benefit from a reopening, and oil isn't too expensive. But when oil gets, really, really expensive, it'll start to disrupt the airline business. So anyway, so you just have to watch that these correlations shift over time. And so there's really no right or wrong answer to this type of question. It's more based upon your justification. If you can explain why, you think oil stocks will do well, and airlines will do poorly if there's an increase in oil, if you can explain that in a relevant and timely way, like relating to, the factors impacting oil right now and airline stocks, I think you could still have a good answer to this SLP question. You just have to really kind of understand your justification for why there's an inverse correlation. And maybe actually pull up the charts and see if there isn't one. I mean, pull up a stock chart of an oil stock and an airline stock, or of a another type of stock that you think is inversely correlated, like a travel stock versus a online retailer or a software company, and see if there's an actual inverse correlation or not. Is it actually showing the correlation, or because a lot of stocks you would think would be inversely correlated and they're not. So just pull up the charts and see if they're moving together, or they're moving at least at sometimes they're moving in different directions, right? So, all right, so counter cyclical stocks. These are stocks that go up when the rest of the market goes down, or go down when the rest of the market goes up. So these are stocks that are inversely correlated to the market. A lot of students pick the triple leveraged short ETFs. That's not really a stock. I mean, I'll accept. To me, I would still consider that answer, but a better answer would be, an actual stock that's counter-cyclical, because that takes a little bit more work to find. Now, Dollar General, some people say Dollar General is inversely correlated with the market, because if the economy's not doing well, then people are going to go to the dollar store to use their food stamps and stuff, because they're going to be, they're going to be using more food stamps. There's going to be more people on welfare. Walmart does better because Walmart's kind of it caters to the lower end retail client. Rent to own businesses like Aaron's Appliances, and rent to own, they do better in a recession. And collection agencies, debt restructuring firms, they do better in a recession. So, I think there's some truth to all of that. Again, it's a situation where you got to pull up the chart and see if what you're saying is correct. Are these stocks going down when the rest of the market goes up? Are they going up when the rest of the market goes down? Is there really, and it doesn't have to be a perfect correlation, but is there really at least one or two examples in the past few years where, there's actually been an inverse correlation? So you pull up the chart on Yahoo Finance and just look at a 1-year chart or a 3-year chart, see if you can find you don't have to spend a huge amount of time on this. Just to try to think of an example that's a good one, and try to just do a little diligence to make sure it's actually got that inverse correlation. Gold ETFs tend to have an inverse correlation. Some people say gold miners too. I mean, a lot of people invest in gold and silver miners due to the inverse correlation. Now, that's an example where I've seen the stock market go down and I've seen gold miners go down. So the inverse correlations don't always work. But the theory behind it is that gold miners should track the price of gold more than they track the market. They should go up when gold goes up, and a lot of times gold is going up when the market went down. That's not always true though. See, all these correlations break down at some point. So, Swiss francs, if you invested in Swiss franc currencies against the dollar, that performed very well in most major recessions and financial crises of the past 100 years or so, as a hedge against the dollar and as a hedge against declining U.S. stock market. But gold has sometimes worked as a hedge, and other times it hasn't. There have been times when gold went up with the market and down with the market, and there's been times when gold went up and the market went down. So at any rate, gold is a lot less volatile than the market. So people buy gold as a hedge. Like big hedge funds buy a lot of gold as a hedge, but the reason they do it, they don't necessarily think gold's going to go up when the market goes down. They would like it to happen because they're buying gold, but they don't know that that's going to happen. But what the thing about gold is, it's a lot less volatile. Even if gold does go down in value, it's going to be down. Like if the stock market goes down 60% over the next 3 months, gold will probably be down 10%, 15% tops, and it could be up or it could be flat. but it's definitely not going to be down more than 10 or 15%, most likely. So, whereas stocks can easily lose 60% of their value, that wouldn't even be, I mean, during COVID, a lot of stocks lost more than 60% of their value. During the financial crisis, the S&P was down 66%. During the Great Depression, the stock market crash in 1929, the U.S. stock averages lost 90% of their value. So, you were left with 5 to 10 cents on the dollar for every stock you had. So, gold has never lost 90% of its value ever at least to my knowledge, in a matter of months or whatever. So, even if gold doesn't, so it's another thing where, yeah, you don't like to see losses on your profit and loss statement on your accounts at the end of the year, but gold isn't necessarily designed to make money. It's just designed to lose less money than other things. If it happens to make you money, great, nice job. But if it happens to lose you less than other things, then it succeeded as a hedge, because hedges are designed to lose money really over time. They're designed to underperform over time, but what they're also designed to do is to reduce the volatility of your portfolio, so that if you've got other risky assets in there and those assets blow up, at least you've still got the gold position, right? At least you've still got the Swiss francs or whatever else you've got, cash or bonds, whatever, commodities, that's supposed to kind of hedge out your stock market risk. So, just think of that as hedges aren't necessarily designed to make you tons of money. Sometimes some hedges are designed to lose money, but they reduce your overall volatility. If they're reducing your volatility due to some of these correlations and due to the lower volatility associated with some of these things like precious metals, then they're doing their job. So anyway, I'll leave it at that for the Module 3 SLP.